Ajay, just wondering then, as an investor, what do you do? Do you deploy this time from now up until when the market would show meaningful returns to try and build up a portfolio, add more to the same, or do you try and juggle it around?
No, I think you need to keep a powder dry. Just now, for instance, you saw, and you get opportunities. Just now, you saw Hindustan Aeronautic, which is a favorite for defense stock for everybody. The day that the government announced that there will be an FPO and the price crashed to almost 2,300, is back to 2,700. So this market will give you opportunities to buy from your buying list. The key is, do you have money to buy when the time comes to buy? Or are you already over invested? I think that's the challenge most Indian investors hold in PMS and everything, that they're already over invested. So I would say this market or any market gives you many opportunities for prices to come down, you to buy. So you need to keep a powder dry, which is why I say at this market, 25-30% cash in the bank is a very good idea at this point of time. And you please exhaust your fixed income products. Go buy government treasury bills. Go buy 10-year dated bonds. I think, they will give you a better yield, because 8% on a treasury bill is a pretty decent yield and is indexed to inflation at the end of the day. So for the indexation benefit on tax. So I would say load up on your stuff. And when the time comes to buy equity, hopefully inverse correlation will start to come in between bonds and equities. At this point of time, you'll be a gainer both ways. But to position only on equity at this point of time, I think is a little worrisome, given the fact that the returns are going to be mediocre and you're going to miss out locking in serious fixed income returns.
Okay, that's a very different view, but yeah, time's call for that. But Ajay, assuming that one does have that 30% lying as balance in banks or cash in bank, besides HAL, what else would you be keeping on your radar to buy?
I think, we fundamentally believe that the metal stories which are there are long-term stories, high dividend paying stories. They're almost in monopoly status. And the fact that no matter what government control does, international prices have a linkage to this. So there's certainly, at any correction, you need to keep buying metal in our view. And that's how, we've been doing that for the last so many years now, quite profitably, I hope so. But the fact remains that you need to invest in companies who are monopolists. That's one. Number two is, high leverage is going to be a killer in this market. It's going to be bad for equities. Interest cost is going to go up. So if you look at the telecom company with 1 lakh crore of debt, they're going to pay a hell of a lot of interest on this cost. So I think interest. Number three is discretionary income product. Whether we like it or not, K-shape is a reality. Indians are high spenders on luxury items. So to that extent, if you look at the hotel industry, done well, will continue to do well in that market. So you need to be cognizant of the fact that this part of the market is kind of inflation proof. Is done, in fact, the reverse. The more the inflation, the better they're doing at this point of time. So therefore, I think and last the least, if government wants to spend 10 lakh crore in capital goods, I think you have no choice but to enter that market. And good part, you got good MNC stocks in the system. Therefore, you can be safely sitting there, high dividends, good no leverage. If government wants to spend this kind of money, they will take it willingly. And you as an investor should partake. Best part, no dilution of equity of capital goods companies. So you're not fearing tomorrow morning there will be a big public issue, etc. So I think if you look at the hospitality sector, look at the capital goods sector, defense, I would say I'm not at this valuation. I'm a little apprehensive of defense, because whatever profit defense makes is going to come out of government allocation from defense. So it's for the government. I don't know which is better. Optics to show higher defense spending in the budget versus giving more profits to the defense companies. And I'm not sure where the trade-off is going to be. And given the policy uncertainty, I would think that they would kind of go in the election year to showing higher budget allocation than higher profitability for the defense companies. There's no transparency. Both are government-owned, so we don't know what who makes, but leave that aside for the time being. I would say private sector is a good place to be rather than PSUs, and they have done better for you as investors. Stick to that. Banking, it's an iffy call, because most investors, willy-nilly, Aisha, are highly invested in banking and with very disappointing returns so far. So I would not top up on banking. I would top up on metal, minerals, hospitality sector, that kind of sectors I will top up and capital goods rather than banking.